Well, hello. The squirrel is here very late at night. It's currently 8:33, which is way past my bedtime. But um, this is something I'm very passionate about, and that is stop losses. It seems to be just standard fare. Everyone tells you, virtually everyone I've ever spoken to says that you have to set a stop loss to avoid being wiped out. Now, I think it's bullshit, absolute bullshit. You don't need to set stop losses, and I don't personally set stop losses, but there's things that I do so I don't need to set stop losses, and I'm going to tell you what I do. Um, I reckon most people won't agree with this, but I don't give a shit. I'm going to say it anyway, and I strongly believe what I'm saying here. I'm not just making this stuff up. This is what I do myself. So I'll tell you what I do, and you make up your own mind whether it's good advice or not. Okay, so these are three things that will make stop losses, automatic stop losses, obsolete. The first one, only make high conviction trades. Now, that sounds pretty simple, but I see a lot of people saying that they don't even need to have a 50-50 success record to make money. And I think that's crazy. So 50% of the time or more, you're buying things that don't go your way. That means you're making lots of trades with no conviction whatsoever. And to me, that's just gambling. I don't know why people would do it. So if you make high conviction trades, so ensure that you analyze the stock complete and you are convinced it is a quality stock that you're buying. So you've got to study the balance sheet, the profit and loss, and the cash flow statement of the company. So you've got to know how to read those. So if you don't know how to read them, you've got to learn. You've got to look at the sector that the company is a part of, and spend time studying that and making sure that the outlook of that particular sector. So whether it's the mining industry or the retail industry or whatever sector, make sure the outlook is good for it over the time frame that you're looking to trade. And now this is something that a lot of people don't do, and sometimes I don't do either. But looking at what the directors say is important, especially if you know the directors and you know that what they say is generally true, because some are overly optimistic and some are overly negative. But if you read back a few reports for the company that you're going to buy, you'll form an opinion. You'll be able to see what they said and what actually happened, and you'll see whether they actually tell the truth or whether they're over optimistic or overly negative. Um, Now, and once you buy the stock, you've got to just keep a close eye on it. Read all the news, just see if anything changes fundamentally for that company. And if it hasn't, then why sell it? If fundamentally it hasn't changed, even if the stock has dropped 10 or 20%, I mean, really, you should be buying more, not selling it just because the price has dropped. And another important thing, and I've said on this YouTube channel, I'm not big on charting. I think people put way too much emphasis on charting and ignore the fundamentals. But there is a place for charting, and that's just right at the end. Once you've decided it's a good stock, you've got to try and buy it at the right price, and that's where charting comes in. So do look at the chart before you make the purchase. So that's, I would say, number one. Make sure you're buying quality, and then you're not looking at a 50-50. You're looking more at an 80-20 or a 90-10. I mean, you're looking for 100%. You want every trade to be right, and don't just buy rubbish. Okay, number two, you got to make sure that the position sizing is correct. If you stick 50% of your capital into one stock, oh, I mean, you're crazy. You're absolutely crazy. Even if you do have high conviction, that's just way too much risk. So I suggest at least 10 positions at any one time. I love 14. Maybe it's my lucky number, but I like trading 14 stocks, generally 10 to 14, because sometimes I'm not fully invested, so I might have 10 or 12 stocks. But if I'm fully invested, I generally have 14. Well, I always have 14 stocks. So then you're looking at about 7% of your capital in one stock, and then if that one of them is turns out to be a turkey, and you lose 50% of the value of it, well, of your whole portfolio, you're only losing 3.5%. So it's not going to wipe you out with one bad stock. Um, and also you've got to manage the size of the position as the trade goes along. So if it's going really well, you might have to just sell a few, take a bit of profit. Nothing wrong with taking some profit, and just keep that position size reasonable in comparison to the rest of your book. That's number two. And number three, something that I'm a big believer in, is hedging your trades. Now, I said I like having 14 stocks. I normally go 7 long and 7 short. So I'm fully hedged against a capitulation in the market. Now, I use CFDs. So some people like to use options to hedge out a bit of the risk. But if you can find a way that works for you to hedge, it'll help you sleep better at night, and secondly, it'll preserve that capital. Even if one of your stocks does fall, if you're well hedged, you might still make money on that day. Another thing I like doing is pairing the stock with another stock in that sector. So I'll pick out a sector, and I'll read all the financial reports, all the information. It might take me a few days to go through all the reports, and generally what I'll get is the stock I like the most and the stock I like the least. So I'll go long on one and short on the other. And then, like I say, that hedges out some of the risk. And if I can't find a stock, say I've got a long that I can find, but I can't find the stock to hedge, I just hedge the index. So sometimes I might have 4 or 5 positions just of the index short, because I can't find hedges against some longs that I like. So look, that's three things you can do to take a lot of the risk away from your day-to-day trading, and hedge out that risk, so you don't need to set stop losses. And at the end of it, I'm not saying that you don't sell losing stocks. But what I'm saying is you stay in control of the trade and don't get forced to sell a potential winner, because the noise in the market makes you sell, and it generally makes you sell at the worst possible time. So there you go, guys. A few tips there on against stop losses. Look, interested to hear your opinion. If you have an opinion, put it in the comments below. I'll be happy to argue with you. Good on you guys. I'll talk to you later.